It's easy to tell someone to pay cash when you have the money. It's easier to tell someone to buy a home with a 15-year mortgage, although the math doesn't add up. There are things I totally relate to from Dave Ramsey, but mortgages is not one of them. So in this video, I will tell you Dave Ramsey's philosophy about mortgages and why it is wrong and what to do instead. So stay tuned. Hi there, my name is Ramsey and welcome to my channel, The Foreigner in America, where I teach locals and foreigners everything they need to know about producing money, keeping the money, and multiplying, specializing in the markets and real estate. So if you're someone like myself who loves money and wants to be successful and free, please subscribe to this great channel and hit that bell so you follow up on my 2 weekly videos. Also check out my blog, Instagram, and social media under the same channel name, and take a look at my book, which is a very, very solid read. I will leave a link below for you to check out. So without further ado, let's begin. When you buy a house, you have two options. You pay cash plus closing costs, or you give a down payment and closing costs, and you get a loan for the rest of the amount. 95% of Americans who buy their first home to live get a loan. There are two options for loans in this country when you're talking about residential real estate on a conventional mortgage. Those are 15-year and 30-year mortgages. If you choose the 15-year mortgage, you get a lower interest rate, which today stands at an outrageous 6.3%. For a $400,000 home with a 10% down, you will be paying $197,377 on interest. If you chose the 30-year mortgage, which is the devil for Mr. Dave Ramsey, you will get a 7.17% interest. For the same $400,000 home with a 10% down, you will be paying $517,078 of interest, meaning more than the actual value of the house. Wait a minute, before you jump from your seat and act all Ramsey saying, "Oh my God, I'm paying more than the value of the house on interest over 30 years. Let me explain you something. The important thing is the payment, not the total interest. 30 years and 15 years is a hell of a lot of time. You don't control your life to the point where you can stop accidents from happening, layoffs, sicknesses, and loss in general. Market crashes, companies going out of business, hurricanes, tornadoes, and earthquakes destroying everything, and many things like that happen in 15 or 30 years. Where am I getting with all this? My point is that your income is not 100% secured at all times. Yes, Mr. Ramsey wants you to have a 6-month emergency fund, but that's worth nothing in a real emergency. That money goes away in a second. Try to pay for a surgery with your emergency money. Yeah, good luck. So if you get a $400,000 house with a 15-year mortgage, your payment including everything is $4,134 a month. The same house with a 30-year mortgage is only $3,474 a month. So it's a $660 difference. And let me tell you what Dave Ramsey says you should do and what the right thing is. Dave Ramsey tells you to go and get a 15-year commitment where you have a company put a lien on your house that if you don't pay, they will take away the house for 180 payments. So $4,134 a month. Let's say on year 1, you're fine. Year 5, you're great. But on year 12, someone in the family gets sick. It's not you. You are insured by your employer, but this family member is not insured. You love this person a lot, and you will not allow this person to die, right? You never lose your job, but you drain your savings. You drain your 401k. You drain every dollar you have to your name. Let me tell you something important. The company that lent you the 360 for your house does not care. They will take away the house and you will lose everything, including the 11 years you've been paying for that mortgage. The right thing to do is you get the 30-year mortgage and you grab those $660 extra and put them as an extra payment into the mortgage. And guess what? If nothing happens, God first, you will end up paying that 30-year mortgage in 15 years, just as Ramsey suggests. Good job. But if the devil steps in and something were to happen to you or your family and you drain your savings, your only obligation is to find $3,474 to pay for your 30-year mortgage and not $4,134 for your 15-year. If you have the money, you pay more and simulate a shorter mortgage. And if you don't, then you're not forced to, and it will be easier to keep the house. Oh, you can refinance the house and change it from a 15 to a 30-year mortgage. Good luck. Good luck doing that when your credit score plummets because you're up to here with credit card debt and you cannot make the payments. Remember, you are in a state of emergency. This is no joke. So no, Mr. Ramsey, getting a 15-year mortgage is putting you and your entire family into big unnecessary risk. You should get a 30-year, pay it off early, and protect your income as much as humanly possible. Let me know if this makes sense to you in the comments. So who do you agree with, me or Ramsey, and why? But do it with math. The idea here is to stop renting forever and get something on your own. Also, the baby steps do not include getting life insurance that pays off the mortgage debt when you die. So if he is so conservative, why not include a baby step that says, after you buy the house with a loan, get a basic life insurance policy that covers the cost of the loan entirely for the term of the loan. So if you die, guess who pays for the mortgage? Your wife and kids. God bless them if you leave them with an enormous 15-year payment like Mr. Ramsey suggests. I guess the wife needs to remarry fast enough to get that one taken care of. But remember, take control of your life and take control of your money. Thanks a lot for watching this video. If you enjoyed it and found useful information, give me a like, subscribe, and hit that bell so you don't miss any one of my 2 weekly videos as soon as they come out. So have a great day. Don't lose any money, and I'll see you next time.